If you have a mortgage coming up for renewal in 2026, like millions of Canadians, or you're thinking about refinancing that mortgage to maybe consolidate some debt and streamline your payments, increasing your cash flow, many different options, many different solutions. But I think there's a lot of things that many Canadians should be paying close attention to as we continue to see the real estate market here in Ontario, especially across Canada. A lot of weakness, a lot of different options, a lot of different suggestions that are coming from the media outlets about what to do in 2026. And ultimately right now, there's a lot of things that are impacting clients' mortgages or their options when they're going to restructure, refinance their mortgage, and even renewing their mortgage with their existing lender. This week, I want to take an opportunity to go through our thoughts and opinions about refinancing and renewing in 2026 and what you need to know before you sign the dotted line. Once again, thanks for stopping by. If you have not yet subscribed to the channel, please consider subscribing, hitting that notification bell so you can stay up to date with everything happening in the mortgage and real estate marketplace. Don't forget to like and share the video, share with a friend if there's some interesting information that you think someone can benefit from. More importantly, let me hear from you in the comments section below. Let's get right into it. So as we alluded to at the beginning of the video, look, talking about mortgage renewals, talking about refinancing, especially in this market, should come as no surprise. Millions of Canadians that got their mortgage back in 2021 that took a 5-year fix had a substantially lower rate than what they might be renewing into right now. And ultimately, we take an opportunity to go through what those payments could look like and the payment shocks at this renewal cliff that could be coming our way. But more importantly, what's really getting a lot of attention from at least us here sitting at our desk when we're talking to our existing clients and new clients that are approaching us is, some of them have increased their debt load. Maybe they've had children, a certain circumstance has popped into their life. They needed to lean on some of these credit cards and lines of credits. And for Canadians that purchased their homes, let's say after 2021 into early 2022 at the height of the market, and if you put less than 20% down or 20% down, well, the reality is there's not really much equity in your home, which means the values have pulled back and the amount of money you can access in your home has obviously diminished. That is to say, unless you've actually paid down your mortgage or put those lump sum prepayment options to work, or you've really hammered down on those actual payments, those increased your payment frequency, rather than do monthly, you've done biweekly. And although that may not make a major shift in the amount of equity or the amount of loan to value, right, that you can access, there are a lot of clients right now that are up against the wall when it comes to what they do next. We get a lot of calls from clients that are saying, hey, look, I bought my home, especially if you buy with less than 20% down at the top of the market, chances are that home is a little bit less or significantly less than what you've paid for it, depending on the location, which means you're not able to refinance that property. Now, maybe your home, you put a significant amount of money down, maybe you actually put a large amount of money down, and you're thinking about your options now that that mortgage is coming up for renewal and you want to look at those options. The reality is if we allow the market to continue at this pace, and we're not saying that, hey, the market's going to go one direction or the other, but if we were to follow the trend right now, looking at values in the current market, well, they're not seeming to go up, they're seeming to either go sideways or down, which means the amount of money that you can access in your home is actually diminishing month to month. And if you're thinking about actually pulling out some equity, you need that equity to do something or pay out some of those debts, you may want to reach out to a mortgage professional, get an opinion. You don't have to sign anything, but just look at your options and figure out what the costs are, especially when it comes to breaking your mortgage early or a couple of months before. There are some options. Now, once again, if you're switching your mortgage, right? If you're just doing a direct switch back in 2024, there were significant changes for clients to provide them with the opportunity to shop around, because before that, it was really unfair. The major banks, a lot of the existing banks, they had to stress test you. Now, as of November of 2024, you don't need to actually be stress tested if you're switching your lender with a federally regulated bank. So if you're going from lender A to lender B, and it's allowed, so you can't go from, let's say, an equity lender or private lender into a bank, but you can go from one of the major banks into another major bank or one of those mono banks, those broker-friendly ones that we talk about. if they allow it, that you can switch over and not have to undergo the stress test, which allows you a little bit of breathing room, especially if your financial situation may have changed. Now, quick point, if you haven't got something from your bank at least about 30 days before, right, a renewal agreement or a non-renewal agreement, at least 30 days before, don't let that slide, because sometimes your bank may renew you for another term. They may do something that you don't like, and then you're stuck. So make sure you're on top of that. Put that in your notes, in your diary. If you have a mortgage approaching renewal in 2026, set that reminder at least 30 days before. If you're watching this video, you're thinking, hey, my mortgage is coming up in 2026, go find your documents, diarize that day, reach out to a mortgage professional, have a conversation about your options, especially if you're thinking about paying out debts. Now, back to the conversation. If your bank has denied you, sometimes the mortgage may be in default. Maybe you missed a mortgage payment or two. Maybe your income has changed. Maybe the home itself is not valued. Maybe there's a measurement or an algorithm within the bank's criteria that doesn't allow it, and they're sending you an option. Don't be too worried. If there is something like that that happens, make sure to reach out to a mortgage professional, get some options, get some solutions, see if there's something that you can do, but don't wait on it. Don't wait till the last minute. We have some clients that reached out to us, they're like 10 days before closing, and ultimately that sort of closes a lot of windows and doors, and it leaves them only open to potentially going into a higher rate or extremely predatory private lender. And then ultimately from there, you know, once you add in all those fees, is there really an option for them to get out except for selling the home? So don't wait till the last minute. Trust me, we see a lot of these situations popping up. A lot of people are also trusting the wrong individuals. If I had $1 for every time I get a phone call from a client, who's watched our video and said, look, I don't know if the broker that I'm working with or the private lender I'm working with is actually doing justice. And then the problem is they tug them along the line, and then they don't give them any options, and they're 6 days out from closing, and there's nothing that we can do because, ultimately closing within that 6-day window, most major banks won't be able to accommodate such a short window of closing for a purchase. Even for a refinance, you may have to be forced into a private mortgage. So once again, all that is super important. So don't wait till the last minute. Once again, in the new year, we also have the potential, and obviously this is something that's already in play, is the changes to some of the mortgage rules. We've talked about the home equity line of credits. We've talked about that on a previous episode. I'll put a link to that video if you haven't checked it out. But super important, banks are going to be a little bit more cautious on lending, especially when it comes to the loan to income servicing. A lot of banks are ultimately looking at this measurement to ensure that they can fund deals or what deals they want to fund. And ultimately they have a choice now, not to say that the stress test is gone, that is still in play, but ultimately now they'll couple it with other different measurements. And as this continues to change in 2026, we're going to keep an eye out on some of those changes. We'll do another video talking about that, so make sure you're subscribed. But to the heart of the matter, to the purpose of this video, is to really reinforce that clients that are looking at their renewals, they have the option to switch lenders. They don't have to stay with their bank. There are different incentives that are being offered across the board. That could be things like a cashback. It could be things that allow you to switch your mortgage over and mitigate some of that cost, especially if you're doing it early. There's obviously a penalty, figuring out what that is and weighing out the options. We have a lot of clients that got their mortgage maybe in 2023 when rates were at 5 or 6%, and they signed up for a 3 or 5 year, they're approaching renewal. Maybe it makes sense to get out of that mortgage a little sooner, wait it out. But until you actually run those numbers and figure out and say, hey, if I was to break the mortgage now, to the end of the year, what do those costs look like? And to simplify that for you, in the description box below is a link to our app. I encourage you to download it. Feel free to use it and leverage the tools in there to make the calculated decisions. There is a refinance tool that you can plug in those parameters and figure out if it really makes sense for you to refinance or it makes sense to stay and write out your mortgage. Those are the real questions. Now, ultimately, at the end of the day, we're talking about that payment shock. We're talking about those changes that are coming for Canadians that are renewing in 2026. And I just wanted to put together a really simple illustration. I mean, once again, this is for one set of clients. This may not be for everyone. This is with a major bank. And this is an actual situation that we came across. The client themselves had an original mortgage that was at about $500,000 when they originated it back 5 years ago in 2021. They got a rate that was at around the 2.5% mark. And ultimately, they took a 25-year amortization. That payment was around $2,243.08. Now, fast forward, obviously, to the current market right now. Obviously, interest rates have gone up a little bit. We were able to offer the client a rate around 3.99 for 3 years. And obviously, their outstanding balance on that mortgage has been reduced significantly because for the last 5 years, they were paying down that mortgage aggressively at a substantially lower rate. So at renewal, their mortgage is now $423,300. This is also taking into fact the clients did not take advantage of any prepayments. They kept their payments on monthly. They didn't update their payment frequency. They were just paying the mortgage. And now, basically, under the new guidelines and the new rates at 3.99 on a 20-year amortization, at 3.99, their payment is $25.6289. And ultimately, right now, if you think about it, I mean, yes, it's still an increase on their mortgage. It's about $319.81 per month of change. Now, this may not be a huge amount, right? You may be saying, it's really not that bad. I mean, ultimately, for most households, that is manageable. There might have to be some shifting and readjusting in their budgets. And, ultimately, they can make that work. But once again, this is a $500,000 mortgage. This is, maybe your mortgage is less. Maybe your mortgage is substantially more. You need to really weigh out the options and ultimately see if, that is something that meets your financial obligations or something in your household's budget if you can make it work. So with that, I just basically want to show that, although there will be some renewal shocks, and obviously considering that if the mortgage interest rates for fixed mortgages stay relatively on course for the next little while, we don't see substantial spikes in the bond market as a result of, let's just say, the budget here and obviously the trade tensions that are happening between Canada and the US and obviously GDP. There we could see the interest rates basically level out here. Not as low as we saw back in 2020, 2021. I don't think we're going to see those for ever again. I mean, hopefully we don't see that ever again. I mean, ultimately at the end of the day, there was a pandemic. So the banks had to adjust, the Bank of Canada had to adjust, and ultimately we're still paying the price, I believe, right now. What we're seeing right now is the hangover effect of all the stimulus and all the low interest rates and basically everything that happened at that time. And the other thing to consider is also the Bank of Canada. Their next meeting is coming up on December 10th. I wouldn't be betting too heavily on a Bank of Canada cut at this particular meeting, but let me know your thoughts in the comments section below. Until next week, thanks for stopping by, and we'll see you all next week.